Is there any way then, with what you've just laid out, that we're not looking at level interest rates, but potentially on federal debt, much higher interest rates, not 4.5%, not 4.3%, but 6%, 7%, a level that would definitely impact consumers and consumption?
That's it. You're reading my thesis. You and I have been talking about this for a long time, actually for 3 years since the modern monetary policy started, of printing money and sending checks into the economy, which we know is inflationary. The inflation, I still think, would have been transitory, but for terrible policy decisions, causing a supply chain restructuring in regard to making China our enemy and the Ukraine war and the like. I think right now, not only are we going to have higher policy rates for longer, but the reason we have rates where they are right now is because the Fed is giving itself room for what comes next. What comes next, which is quite remarkable, is that the Fed's balance sheet is still over $8 trillion. 15 years ago, it was at 500 billion, less than a trillion. After the financial crisis and years of QE, it was 4 trillion. The pandemic drove it up to 9 trillion. And people have been talking about quantitative tightening for a long time.
But it hasn't happened, really. You point. It hasn't happened.
Basically, what's been going on is trillions have been maturing, and the Fed has been, rolling them down the curve and buying them on balance sheet. Any day now, the Fed is going to be obliged to start to reduce the size of its balance sheet because it's just not credible for the Fed. It's a classic Ponzi scheme for the Fed to continue to buy all the treasuries that it issues. And what's going to happen right now is a gigantic withdrawal of liquidity from the market as the Fed allows bonds to mature and be refinanced out in the private market without sovereign bids because of the re-regionalization that our policy has created.
So let me...
private markets are going to set the rate. And like you said, I've suggested that the 10-year rate is probably going right past the historical average where it is right now. We could wake up pretty abruptly when people connect these dots fully and see the 10-year at 7 or 8%, maybe even higher.
So let's bring this kitty around third base and to home plate. What does this thesis hypothesis mean for stocks, for bonds, and for consumers?
Okay, so let's say the Fed wants to cut its balance sheet in half. That's $4 trillion of liquidity that needs to come from private markets, domestic and abroad, and those markets are going to set the price. That money is going to come from other asset classes, I would think, starting with equities, and it's already happening to some degree, but equities have remained a relatively strong bid. I'm not all gloom and doom here. I think this is a very necessary and normal reconciliation. And, we've got everybody over leveraged. Household savings are depleted, credit card and mortgage debt at all-time highs, corporate debt at all-time highs. And as you said, federal debt. I mean, we're financing trillion-plus deficits. The debt service on the federal debt alone right now is a greater expenditure than defense and Medicare combined. So that's just not good. We got to reduce the national debt. So to your point, it's all about politics. The last time anybody talked seriously about fiscal discipline was Paul Ryan when he said that the United States was insolvent when the Fed's balance sheet was $1 trillion back in 2011. Yeah. Where is Paul Ryan right now, a former presidential candidate? He's running a SPAC. He's in the investment business in the private sector. Yeah. So what we need is real leadership that's going to have real discipline, not just to kick the can down the road.
Well, that
tape and Band-Aid
that
and
is
continue to sort of live to be reelected. But we need very serious leadership to make some very difficult decisions
from your lips, as they say, to God's ears on that one.